While it may seem hard to believe after 3 weeks of relentless selling pressure, in this week's video, we'll review charts that help us understand why a really big move could still be coming in stocks. Let's run over some stats and then let's talk about how they might be relevant to protecting and growing our capital going forward. Our buddy Urban. Persistent selling and volatility like this is ultra rare, like once in 50 years rare. Bespoke Investment Group. If the S&P 500 finishes at current levels, it will be just the 9th time since 1928 and the second time this year that it fell more than 10% from an all-time closing high in less than 6 weeks. This is the S&P 500 daily. It was knocking on the door of a new all-time high as recently as October 3rd. And then once the selling started, we almost had a stampede towards the door. As always, we'll be showing numerous examples of hard evidence that we're using as a proxy for the weight of the evidence. S&P 500's 200-day moving average, October 19th, October 24th, and October 25th. If we're seeing tweets like this, and seeing a decline of this order of magnitude over 3 weeks, it tells us that at some point in the future, especially if it occurs relatively soon, it's important to be aware of this possibility. Dot-com bust bear market. The S&P 500 dropped 51%, but it took 930 calendar days. Fast forward to the financial crisis bear market. We dropped further, and in this case, instead of 930 days, it only took 517 days. Given this type of behavior and these type of statistics, if we extrapolate the increase in magnitude, 51% to 58%, it's possible the next bear market could see a 66% loss. 930 days, 51% loss. 517, 58%. A similar shift between this point and this point tells us it's within the realm of reason that we could fall 66% more than this bear market, and it could happen faster. How can that be? We're seeing some signs of it on shorter-term time frames. We know that painful memories tend to get etched in our mind. It's very, very easy to recall them. Therefore, many investors have this attitude. You may have fooled me once, and you may even have fooled me twice, but you're not going to fool me 3 times. I'm hitting the sell button. I've seen this movie before. I'm getting out. In this bear market here, relative to this bear market here, in this case, the rate of deterioration in the evidence tracked by the model is faster. Thus, the model moves away at a faster rate. If this hypothetical scenario occurred, the same thing would occur. The data, the slopes would be steeper, we'd be dropping faster, we would move away from risk and reallocate at a rate that's in line with the change in the hard evidence. We drop faster, move away faster. Drop faster, move away faster. Every case is different, but those are the generic and hypothetical concepts that we should be aware of. S&P 500, October 26, 2018 close. We have some concerns here. Failed breakout from this point. Failed breakout relative to this consolidation box here. We have our 50-day rolling over, which is no big deal. But now our 200 days starting to roll over. That's not a showstopper, but it is telling us the longer-term trend is more vulnerable. S&P 500, when we made this high on September 21st, 2018, we had a noticeable negative divergence with daily RSI. Just a week ago, 7 calendar days ago, the S&P 500 was holding above both the 50 and 61.8% retracements that we've been following since September. If we fast forward, we learn something either way about probabilities. We learned something if the market holds here and moves in this direction, and now we've learned something because on October 26, 2018, we closed below all 3 fibs, simply telling us the probability of a trend change is higher today than it was a week ago. October 26, 2018, NYSE Composite Daily. Long-term consolidation here. We get a bullish breakout. At this point, we have a very good look. The longer a market goes sideways, the bigger the move we can expect to get. Fast forward to Friday's close. Now we have a very, very concerning look. A failed breakout and then a plunge to the bottom of the box. And now we have what appears to be a bearish breakdown. The longer you go sideways, the bigger the move we can expect to get. And if we zoom out on this chart, if, and I emphasize if, the market decides to move in this direction, you could make an argument that we could come all the way back and retest this high here. And as of October 25th, that represents about a 7% drop, which is one of the many reasons why until the data improves, we will continue to incrementally reduce risk exposure. Now back to the very concerning look for the NYSE Composite October 26, 2018. When we see this, it's very, very easy to extrapolate price in this direction. Let's look at a historical example. Emerging markets. 2009, they enter the box. The longer you go sideways, the bigger the move you can expect to get. Support, 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 drop below it, and then closed above it here. And then we get a bearish breakdown below a multiple year consolidation box. Very, very tempting in here to extrapolate in this direction. And I can tell you, this move here was not fun for anyone that owned emerging markets. And this point in 2016 was not fun for anyone that owned any equity-based ETF for the most part. Very uncomfortable, very unnerving in here. The psychology of this look here is very, very similar to this unnerving look here in the present day. In this case, what happened next? This is an example of why we have the term false breakdown. Instead of moving in this direction and dropping like a stone, this is an example of our nimble barge look where the market changed its mind very, very quickly, reversed course, and instead of plunging, the gain from this point here to this point here in 2018 was 88.9%, telling us in the present day, we can find lots of charts with scary breakdowns. It's really important to keep an open mind about all outcomes. You can find this on Twitter. For our approach and our process, important takeaways. Our goal is to be allocated properly for the next 3 months or 3 years, rather than the next 3 hours or 3 days. To get there, we may have to increase trading frequency, experience some whipsaws, and deal with emotional swings. We would rather do all of that. Trade more frequently, experience some whipsaws and wild emotional swings. We would rather do all of that as long as we can get positioned properly for the next big move. It feels like the stock market's fallen a long, long way. And it has. But it's very, very possible the magnitude of this move here will pale in comparison to the next move, which could be in this direction or this direction. So earlier this year, January 26, 2018, here it looks like we finally broke out above this long-term consolidation box. We have a successful retest, and then we went on to make a higher high. How does this chart look today? Not nearly as impressive. This is the end of our 88% move here. This is no longer a successful breakout. This looks like a failed breakout. As this emerging markets example shows, we must absolutely positively have realistic expectations about stock market volatility in the coming days, weeks, and possibly months. In terms of keeping an open mind about a reversal soon. Sentiment trader, very, very rare combination between the VIX and the S&P 500. The last 2 times it happened, after a plunge, stocks reversed. After a plunge, sharp reversal. This tweet here tells us to be open to the nimble barge move in this direction. This breakdown here tells us to be open to really, really bad things happening until the market can prove otherwise. It has to prove it. Similar situation with the global Dow. Multiple year consolidation, bullish breakout, and now we're back down testing this area here. What once acted as resistance here, price came down, may now act as support. This is another chart that tells us we could get a big move in this direction if this holds, because that means this breakout is still in play. And if we get a failed breakout here, we know that could be ugly. Maximum flexibility. Let's revisit. Our temptation here is to extrapolate. The 200-day is rolling over. We know what's going to happen. The 50-day, we know what's going to happen. It's going to roll over, and it's going to cross below the 200-day. We're going to move quickly here. We've covered this before. It's tempting to extrapolate. What happened next? Probably not what we expected. Now we have a really ugly look. What happened next from here? We know what's going to happen. Well, that's not what happened. We rallied sharply. This is a multiple week rally here. But then we come up to a flat 200-day, and it looks like we failed. Once again, easy to extrapolate. That really would not have paid off. It's interesting to note that this historical year that we're looking at was a midterm year. What happened next after all of this? From this point here, it looks very bullish. Prices above, turning back up. Bullish. Easy to extrapolate here. Next, ugly. Difficult. Frustrating. This is early October of a midterm year. What happened after point A? 200-day turning back down. Price below the 200 and the 50. Looks concerning. And yet, here's our point A here. We were looking at the midterm year 1994. From this point A here, and after all of this concerning price action and moves in our moving averages, the world didn't end. The S&P 500 gained 237% over several years. This is October 6th, 1994. Maximum flexibility and no extrapolation. We know out of an indecisive look like this, we just showed what happened next, 237% gain over several years. We also showed earlier in the video that present-day psychology tells us people could run for the exits at breakneck speed. So we have to respect the observable changes in the hard data tracked by the model, and we have done that, taking incremental steps to reduce risk and raise cash. Let's quickly walk through this year, 2018, see what we can learn. We have the sharp rally, then a big correction, consolidation and sideways movement. We get a bullish breakout, and the bullish breakout is accompanied by a noticeable and concerning RSI divergence. Well, in all actuality, this may look like 2018. This divergence here and this price action looks very, very similar to the price action and divergence that we've seen in 2018. What happened next in this historical case, and what year are we looking at? From this point A here, a concerning look. The S&P 500 gained 143% over the next 1,369 days, telling us to keep an open mind about all outcomes. You have to take it day by day and stay in the now. Here's another example. 200-day moving average. So this is very, very similar to what we're seeing in the present day. This occurred in 1984. What happened from this point A here? This point A righted itself, resumed the primary trend, the long-term trend that started in 1982, and tacked on an additional 897%. And between point A and point B, we have the 1987 crash and the 1990-91 recession. We have the midterm year in 1994 that we covered, and a big dislocation and a lot of volatility in 1998. And yet, the gain between point A and point B, 897% after this look. Purpose of the exercise is simply to say we have to take it day by day, and extrapolation is extremely dangerous. We've also shown with the breakdowns and things that we've seen, it can be extremely dangerous to ignore these type of moves. S&P 500, NASDAQ, October 12th, 50,200. Fast forward to the present day. This isn't a disastrous look, but this is our inflection point look. We're seeing a lot of inflection point data in the model. What do we mean by that? We're flipping back and forth intraday between zeros and ones. About a third of the questions asked in the model right now have this type of look for the most part. They could go either way. Flat 200 days tell us to keep an open mind about anything. A resumption or something ugly like this. A flat 200 day. A flat 200 day. Is it possible that this move here is the market's way of sending us a wake-up message? Something has changed. Absolutely, positively, yes, it's possible. Is it possible that a sharp move in this direction, and even a case where the S&P 500 futures go limit down, a sharp move in this direction, a plunge, a case where the S&P 500 futures go limit down, this is worse than anything we've seen in the present day, and we know what happened next. A sharp move in this direction, telling us to keep an open mind about all outcomes, from wildly bullish to wildly bearish. We have to take it day by day. It's possible it's going to be frustrating for a while. We have to have realistic expectations. It's possible this move and the present day move align with this quote that we've been covering. October 12th, no question we have some deterioration here, but it's not a major crisis yet. We don't have a look like this yet. We have a we better pay attention look. Now we're below the moving averages. We've gone up, and now we're coming back down. Until this clears up, the market has proven nothing so far. Until it proves something, we'll continue to err on the side of being defensive and aligning strictly with the facts in hand. From a longer-term perspective, As of the close on Friday, October 26th, the S&P 500 index is down about 0.5% year to date. It's basically flat, telling us that if we had a good look on the annual chart at the end of 2017, which we did, and we had a good look in July of 2018, and we were only up 2% year to date then, this chart has not changed in a material way, and if we rally into year end and put a 7, a 8, a 9, a 10 here, this chart will look fine. It's been frustrating. All is not lost. SPY year to date still up 0.7%. QQQ up 7.5%. And we still have ETFs as of Friday, October 26th that are up over 10% year to date. However, all of this was originally presented to help us keep an open mind about better than expected outcomes. Given where the hard data is in the present day, we really don't have the luxury of focusing on this time frame, which means until there's some resolution, these shorter term time frames are really what matter. So is it possible that the divergences that we've been showing on Twitter will help the market move in this direction? What's going to happen here? Are we going to stay below the fibs on the S&P 500, or are we going to reclaim them? We will learn something either way. We also have the divergences on the S&P 500 daily helping us keep an open mind about better than expected outcomes. However, there's really nothing to write home about in these candles here. This is an indecisive look here. It's a pause look. It basically says the bulls and bears, for the most part, had a draw as far as buying power and selling power goes on Friday. A pause could pause and move in this direction, or we could see some constructive candles here. If we were taking a multiple choice test, it's unlikely that we would choose this as a high probability bottom in its present form. If we get another candlestick over here, then that changes. We just don't have that yet. This type of look, the flat moving average here, says it's irrelevant what's going on this chart here, because even if all of this is still in play, it could still get ugly before a bullish trend resumes. And here's an example of that. 1984, it could still get ugly before the bullish trend resumes. Last week we talked about the overrides in the model. How many weeks did it take for the overrides to be wiped out in terms of the shorter term data? 2 weeks. 2 weeks from knocking on an all-time high, the model is back in full control. All inputs are relevant. Which means, as of Friday, October 26th, we are allocated in line with all of the model's inputs. None of them, from the fastest to the longest, have been screened out. In terms of what we do going forward, it's going to be those shorter term time frames that dictate it. Is the VIX going to go on and make a higher high, increasing the odds of a plunge? Or is this lower high, lower fear, and this slowing momentum look going to help the S&P 500 right itself from an ugly profile and rally strongly for several years? Everything that we've covered in these weekly videos during the bullish period, all of the concepts still apply. Nothing has changed in terms of what we look at and how we use it. What has changed is the market's trend, telling us if we want to get on the right end of the next big move, we may have to increase our trading frequency. We're going to have to hold our nose and look the other way. We might experience some whipsaws. What does that mean? You buy on a Thursday, and within 2 or 3 days, you have to sell again. That's frustrating. And we may have to deal with emotional swings. There were whipsaws and emotional swings in here But if you increased your trade-in frequency and got on the right side of the trade, eventually big rewards followed. There is a ton of additional content on our Twitter feed. Anyone can access it. It's just a web page. You can find it by Googling Shavaco Capital Twitter. And if the markets continue to be volatile for clients, we will continue to provide frequent updates on the CCM Twitter feed. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.